Good morning, good afternoon, and good evening, wherever you are. Welcome to a very exciting session. I'm Carson Neuhov, Senior Researcher for Climate Policy and Sustainable Finance at the German Institute for Economic Research in Berlin, and I will guide you through the session. We have today 60 minutes, 4 speakers and 1 guest commentator, and according to the website, incredibly, over 170 registrations. This is really great. So what's coming next? We have 4 speeches that tackle the issue of climate financing from very different angles. I am then very delighted to have Tasneem Essop here as our guest speaker, who is then reflecting on the presentations, and we will then directly start a discussion and Q&A session with you. So what is the session about? International climate finance is at a crossroads. 12 years ago in Copenhagen, the developed countries committed to mobilize $100 billion annually in climate finance for developing countries. However, there are indications that this promise will not be kept. OECD figures show that the total figure in 2018 and 2019 only amounted to approximately $80 billion. We don't have the exact figures for 2020 yet, but due to COVID-19, it is not expected that they are going to be higher than in previous years. So in this session, we will explore for and with you the challenges and opportunities of aligning development finance with climate action, the role of national policy making in unlocking international climate financing, the critical role of export credit agencies and multilateral development banks, and the extent to which previous climate targets have been met, and the potential characteristics of the post-2025 target. Next slide, please. We are all aware of the important role of private actors in the alignment of financial flows and the implementation of NDCs. So please be informed that in our session, however, we are placing a strong emphasis on the role of public finance. I'm now handing over to our first speaker, Carson Neuhov, who is leading the Climate Policy Department at the German Institute for Economic Research in Berlin. He focuses on the economics and financing of a low-carbon transformation in various industries, investigates how policies and markets can be designed to achieve carbon neutrality. And he's giving advice in projects for national governments, EU Commission, international organizations. Carsten, the floor is yours.
Hey, everybody. Very happy to present and discuss together here now. What I want to talk about is how international public climate finance is supporting domestic policy implementation, which is the key theme of the topic of the project that we are working together with our partners in India, Indonesia, Brazil, and South Africa, as much as across Europe, as you can see them here. What I'm particularly interested in sharing today is a few propositions on how climate neutrality as a new emerging norm can strengthen the opportunities for the collaboration on climate policy. And what does this mean for the design and role of international public climate finance? If you go to the next slide, please. On this map, you can see a set of case studies where international climate finance was contributing to the development of policies and actions in various countries. And for these case studies with our consortium, we reviewed the literature and interviewed the partners in those countries. We wanted to find out, did the support provided improve the outcome and result in a transition and transformation towards mitigation or adaptation in the countries? And if you go to the next slide, you'll find the insights that we formulated based on these case studies, as much as a lot of additional national studies that we're working on. And we found 3 core propositions across these studies. First of all, it's important that the identification of specific support needs is engaging. So national ownership is central for the success of policy implementation. That's what we found over and over again, as it's quite clear. But the tricky part often is that these policy processes have their own dynamic. The window of opportunity for change is opening often quickly, and unfortunately also closing as quickly afterwards again. Therefore, across the studies, what seemed to be important that one can strategically identify opportunities for cooperation, but then retain a lot of flexibility to tailor that cooperation to the focus and the timing of national processes of partner countries. Second is the alignment of international climate finance and domestic policies. I think ultimately this is the objective to support policy or priorities objectives in countries, and on this basis structure the approach and the funding and the timing of international climate finance. We found, for example, nice examples of this. Our Indian partner Terry was looking at the green energy corridors, where KfW funding provided tailored support to kind of extend the grid such that a lot of additional renewables could be integrated in the system. Or Cape Town University looked at how the renewable tendering agency was also brought forward with international funding and overcame barriers for additional deployment of renewables in South Africa. I think across the study, we see obviously that domestic political will is essential for the success of policies. One part perhaps was the long history we've now seen for the Amazon Fund in Brazil, where the our partners, the FGV, looked for the developments over the time and saw how this will and the cooperation often was more important than the funding and beyond capacity building that kind of was only coming later on in the process. There are a lot of other elements we found that were often present, as you can see here on the slide. But if I look back at this table now, what you see is we focus so far often on the in-country processes in the recipient countries. What you didn't see on the slide so much is what is the role of the international partner. And I think that is somehow almost separate discussions. We have right now the discussion of the pledges of 100 billion international climate finance, hopefully building up now gradually over the next days to reach this target as soon as possible and go beyond it. But does this money come through some anonymous international channel? That's the question which perhaps we can look at in the next slides. We are increasingly interested in looking at how this cooperation works. And perhaps let's use Elinor Ostrom, Nobel laureate in economics. She's been looking at cooperation mechanisms and cooperation principles, and perhaps learn from her ideas and elements how such a cooperation can work. One key component she identified for cooperation is a shared norm. And I'm really excited to see how climate neutrality seems to now become a new shared norm, if you move on forward, as towards which countries are pledging, organizations, private, public, are committing to this. I think it makes a big change relative to the Paris Agreement, which at least I always struggle to explain in a lot of detail in the German context. Climate neutrality, I think, is far more accessible as a shared norm on which we base and work together. If you move one forward, please. The next animation that comes after this looks then at reciprocity. I think the second component that Elinor Ostrom was focusing upon is reciprocity. So historically, when I started this project here, I thought it's very much about there's international public finance provided to a country in exchange for certain mitigation or adaptation measures that are being pursued in this context. And I think what we found in this approach, and certainly what I think is a very strong message from Ostrom, is that in the context of cooperation, reciprocity means that all partners have to contribute. And I think the example to look in this context is a very simple one. If you go with a set of friends to a vacation and you share a flat, and not everyone has a lot of cash, then some people might contribute more to the rent of the flat. But ultimately, does it mean that the other people in the flat will have to do all the cleaning and all the cooking? Probably not. That's not the way cooperation works in the flat sense, and I think in the international cooperation sense as well. So what does reciprocity mean is that international climate finance cannot be a one-way stream of funding being provided from an anonymous channel to other countries, but it needs to be something that is embedded in a cooperation between countries. It's only one part of the cooperation of countries that jointly want to achieve a inclusive, just transition to climate neutrality and resilience. And therefore, it is something which needs a commitment from both parties towards more action on the space. And this more action can be action in terms of strengthening targets, but we also find increasingly how it is requiring a lot of effort to achieve these targets, to implement policy measures. So perhaps the cooperation is in terms of jointly developing strategies for inclusive transition, for example, of the industry sector, and then implementing measures, learning from each other, exchanging these elements in terms of achieving this transition. And then international public climate finance is one component of working together on such an inclusive transition between partner countries. Certainly, if I step back, in Germany, if I look at the public discussion, if we were to cooperate more closely with other countries on such a transition, I think it would be very welcome for the debate to see, look, other countries are pursuing this, and here's how we can work together and do work together with other countries on this. I think it would give a boost to action, to climate action, also in Germany, and therefore hopefully have a similar reciprocal element in other countries. Let me highlight one more element that we found in these studies. That's the connection of political and implementation levels. So often we find that climate policy cooperation is something that ultimately is at an implementation level done at the technical level in ministries between the countries. And I think that makes a lot of sense, works often quite well, but if the objective ultimately is political buy-in and sign up to transition processes and political implementation with political will, then that is insufficient. So somehow the cooperation in an Austrian sense needs to kind of go also more closely to the political level in the partner countries that cooperate on such a transition to climate neutrality in a specific sector, for example. And I think this historically might have been difficult if we only talk about, as I perceived it at least, climate finance to be provided in exchange for some action. Then I think for a policymaker, it might be difficult to say, hey, we accept this climate finance and in exchange, we implement this measure, which might have tough implications. If now it's a sense that one jointly pursues these transition strategies, I think then also that is far more attractive to be part of this process for a policymaker and to be part of this transition process there. And I think we've seen this right now, if we look at the announcement of the South Africa project into a just transition out of coal. I think that was something both in South Africa and also in the partner countries being perceived quite attractive as something everyone wanted to be affiliated with such a process.
1 minute left.
And that's, I think, also where I would like to stop. Let me summarize. I think climate neutrality as an emerging new international norm, I think is really giving me a lot of hope that cooperation can become even stronger. It's a lot stronger now as we move forward. We have a lot of ideas, proposals, propositions, how cooperation, what are important elements of cooperation. Many of them you see here, many of them are well established and implemented so far. I think there are two additional components which might receive now more attention. One is really think on reciprocity as a joint cooperation across countries towards a transition and having climate finance as part of this cooperation where there's mutual commitment to action beyond climate finance. And the other one is a stronger commitment and link to the political level of partner countries involved in such cooperations. So very much looking forward to the discussion, and back to you, Catherine.
Thank you, Carson. This was really insightful. So we are now heading over to a really specific actor in the domain of climate financing, multilateral development banks. Next speaker would be Carolyn. She's a research analyst at the Sustainable Finance Center in the World Resources Institute. She focuses on enhancing Paris alignment in public financial institutions and helping countries access finance to fulfill climate goals and address disaster risks. Prior to joining the World Resources Institute, she was a policy analyst at OECD, where she supported governments in integrating environmental and climate objectives into development finance. She's presenting as part of the research consortium of German Watch, New Climate Institute, and World Resources Institute. So, Carolyn, floor is yours.
Great, thanks, Catherine. As mentioned, we'll be talking about the MDBs and how they can align their policy-based financing. And this work is a result of a consortium funded by Germany's Federal Ministry for Economic Cooperation and Development, or BMZ. We work to complement the MDB's alignment efforts. Next slide, please. So this is the all too familiar, probably, MDB's joint approach for Paris alignment, which is based on 6 building blocks. Most effort so far has focused on methods for aligning direct investments under building blocks 1 and 2, policy-based financing remains kind of a glaring gap in alignment efforts in this regard, especially after financing about doubled during the COVID-19 crisis from the previous year. And it can play a significant role in supporting things like NDC revision cycles or in aiding in the establishment of long-term strategies under Building Block 4 in particular. Next slide. So what happens in a policy-based operation very quickly, or a PBO? So a recipient member country will request budget support, and the MDB would aim to fill that shortfall in exchange for the country completing pre-agreed upon policy and institutional reforms. These pre-agreed upon reforms go by a few different names: policy actions, conditionalities, prior actions, all the same things. And they can have harmful impacts on a country's ability to fulfill its climate objectives. Some PBOs, for instance, have been shown to incentivize new fossil fuel investments in countries, but they can also incentivize very important reforms for the climate transition. So keeping this in mind, we propose two key criteria for a Paris-aligned PBO. They should not undermine climate objectives, kind of going back to this minimum do no harm standard, but they should also, wherever possible, include and promote climate action. And within either of these areas, we're talking about mitigation, adaptation, or the just transition as well. Next slide. So our methods include desk research and staff interviews, as well as data collection and analysis of MDB's policy-based financing in the past 5 years. And then we also conducted deeper dives into 3 key policy areas, and we'll showcase some of the initial findings for aligning public financial management, or PFM, reforms supported by PBOs later on in the presentation. But first, we'll go over what the typical process that MDBs undertake in formulating these operations. Next slide. So it was clear early on in the interviews that aligning a policy-based operation would require mainstreaming climate considerations from the start of their formulation. So we mapped out these steps that banks take in preparing a PBO, and we elaborate alignment criteria where necessary within that. Another very important consideration to this approach is that policy and institutional reforms can be very context specific and complex. What works in one country or makes sense in one country doesn't necessarily make sense in another. So taking more of a process-oriented approach can be more adaptable to these kind of considerations. So when a recipient member country requests a PBO, banks engage in dialogue and coordination for the operation, and to support alignment in these steps, staff should be identifying any potential barriers or entry points for climate reforms and attempt to address these through additional grant financing or technical assistance where it makes sense. I think this very much goes back to the coordination and collaboration that Carson was speaking about in his presentation. And while not a part of the PBO itself, a really important document for this is the Mdb Country Strategy, because they're kind of the key input that forms the basis for this dialogue and coordination. So banks should really be elaborating their role in supporting national climate plans and using Paris-aligned scenarios in any sort of bank-supported diagnostics within. Next slide. And this will feed into the operations concept paper, which includes analytical work to help determine the policy actions that are going to be required for budget support. And these analytical pieces should account for climate objectives, as well as identify and aim to minimize climate risks. And once banks outline these policy conditions, they will then conduct risk screening or potentially apply some safeguards. And we'll elaborate on some of the additional criteria this can entail for alignment when discussing public financial management reform in just a few slides. Next slide, please. Once the concept paper is complete, the operation has most of its elements in place, and it moves to the fulfillment of these agreed policy actions and to board approval. Next slide. So we'll jump into the public financial management reforms. I think it'll help make things a little more concrete. Next slide. Our analysis is based on a representative sample of PFM operations and their policy actions in 2018 through 2020. And the figure here uses that data and shows, perhaps unsurprisingly, that stimulus-related actions grew most as a share from 2019 to 2020. Next slide. So we take a similar approach here as in the overall PBO process. We map the different PFM reforms in the sample and elaborate alignment criteria where necessary within. And by kind of diving deeper into these areas, we give more of a sense for what types of reforms banks are supporting in PBOs and why alignment matters. So this slide shows the areas of overarching revenue management supported by the MDBs. Separated into 2 categories and 3 subcategories each. Next slide. And this is very similar. It maps out the reforms that direct or improve public spending to more specific services or sectors. State-owned enterprise and public-private partnership management are separated because they're a bit more idiosyncratic in that regard. And for alignment criteria, we elaborate doing no harm to climate objectives and supporting opportunities for action within each subcategory listed. Next slide. This is based on the types of reforms that are often supported under these areas. For the sake of time, we'll only cover the alignment criteria identified in one of the revenue management subcategories and then one for government spending. So for budgetary governance and development planning, one type of policy action included in PBOs involves introducing or improving regulatory impact assessments. And these inform budget decisions and oversight, and they tend to focus on economic costs or benefits, which I'm sure everyone is aware. The more traditional economic costs and benefits can undermine climate objectives by failing to account for impacts of different regulations on emissions, including things like the social cost of carbon, or impacts on adaptive capacity and thus climate resilience in the country. So for MDBs to do no harm to climate objectives in supporting regulatory impact assessments, they should be aiding countries to include climate impact assessments as part of such reforms. And just to give an example of one way they can support climate action in this space, they can help countries to establish green budget tagging that aligns public spending with climate objectives. It can help to identify gaps in financing. Some countries have even used their green budget tagging to then issue sovereign sustainability bonds, which can help to fill these gaps. Next slide.
1 minute left.
And then for public-private partnership management, a lot of the policy actions here relate to governance and risk management procedures, but also specific actions for project development. And this includes policy actions for initiating bidding or tendering processes for a PPP project. So for MDBs to do no harm here, they should be supporting disaster response plans, as otherwise they can risk increasing vulnerability to physical climate risks. And to support climate action, they can increase capacity to design low emissions climate resilient infrastructure through commonly formulated policy actions that might change staffing or institutional structures or issue new operational guidelines. Next slide. So thank you for your time on behalf of our consortium. Here's some links to some of our other resources on Paris alignment, and I look forward to more feedback and discussion in the Q&A.
Thank you, Carolyn. Not to mention that we will post also the links to the studies and project also in the live chat during the presentation, so you can easily access and download the content. So let's now go to another specific actor in climate financing and shed the light on export credit agencies. Philip is a researcher in climate policy, consultant at the Perspectives Climate Research Group. He works on projects including the alignment of public financial institutions with the Paris Agreement and sustainable finance in general, as well as on the UNFCCC processes, including projects on climate finance, NDC updates, and Article 6 negotiations. Philip, the floor is yours.
Thanks a lot, Catherine, for this introduction. And yes, now we also see my slides, and greetings to everyone from Glasgow. So in this presentation, I will focus on the Paris alignment of export credit agencies. And next slide, please. And our discussion is in general taking place right in the general context of Article 2.1c of the Paris Agreement, so the role of finance in the Paris Agreement. And in general, one can distinguish between public and private finance. And as Catherine already mentioned, in this event, we mostly talk about public finance, although I want to highlight that export credit agencies have an outstanding role for enabling private finance businesses overseas. So these two components are also intricately linked. And well, we see the special responsibilities for public finance institutions because they bear the climate commitments of their respective governments. This is why it's particularly important, I think, to talk about public finance institutions in the context of Article 2.1c. And well, in general, we can distinguish between three types of internationally active PFIs. So the multilateral institutions, which is, for instance, the World Bank Group, the African Development Bank, Asian Development Bank, then the bilateral finance institutions, which is, for instance, the German KfW or other development finance institutions, and export credit agencies, on which we focus today. Next slide, please. What are export credit agencies? So they can be public agencies like UKEF, UK Export Finance, which is the British ECA. It's a government department. They can be import-export banks like US Exim or China Exim, which are publicly owned banks, or they can be mandated private entities like Euler Hermes in Germany or Atradius DSB in the Netherlands. And their objective is to promote domestic exporters in foreign markets, which is in export-oriented economies like Germany or Netherlands really one of the driving vehicles of our model of economic development that has brought to the Western world and to many other countries by now their prosperity and their level of GDP. And their main instruments include guarantees, which is a kind of cover for projects abroad. It's a de-risking facility, so private actors are more likely to conduct such a project. This is for pure cover ECAs. There are also some that have a more diversified portfolio or product portfolio that also include direct loans. And you can see here on the right a little schematic overview of a simple transaction where an exporter in country A exports something to country B, pays a premium, gets an insurance that the importer also pays the money for the goods and services exported. So this is a typical ECA transaction. There are many more. ECAs also do transactions with banks, so this can get very complex. But let's keep it simple here for now. And in general, export finance is regulated at least within OECD members and participants to the OECD arrangement, by the OECD arrangement, which is the major international policy framework, which is supposed to lead to a so-called level playing field. Also, because we talk about unlocking 100 billion, ECAs are accounted under the 100 billion goal under the UNFCCC and the Copenhagen pledges, but their share is minuscule so far. So in 2019, it was just 3.3%. And one last thing that I should say about ECAs is that they have this insurer of last resort mandate, which means that they are only supposed to insure or support projects for which private insurers would not assume the risk anymore, which in reality is not always the case, but in most mandates of ECAs, this is something that's written. Next slide, please. Just to underline the relevance of ECAs in comparison to other PFIs is the largest. They are the largest category of PFIs in terms of providing support for energy sector. Compared to DFIs and multilaterals here in this graphic by Oil Change International. Next slide, please. And if we zoom into this energy sector finance, we see that the vast majority of this finance is continues to be directed towards fossil fuel energy projects. And actually, these numbers have been updated a few days ago by OCI, and between 2018 and 2020, the trend continues and even increased slightly. And we saw that G20 ECAs finance 12 times more fossil fuels than renewable energy sector projects. And this is why this topic is really, over the last years, where before only MDBs and some bilateral finance institutions have actually received relatively much media attention, we see now really ECAs popping up in media, in research circles. And we've seen in the last 1 or 2 years, we saw very important announcements that China, for instance, will not build coal-fired power projects abroad anymore. We have the Export Finance for Future initiative now, where 7 countries committed to some targets. This morning we've seen a coalition of plus 20 countries to ending support for international public finance for all types of fossil fuels at the end of 2022. This was announced here at COP this morning, and there are some caveats to this, but maybe we can discuss this later. Next slide, please. What we do at Perspectives is, over the last year, we developed a methodology to really underpin this label Paris alignment with meaning. So we basically developed clear-cut benchmarks to assess and then compare ECAs and their respective governments as part of the national export finance system on their alignment with the Paris Agreement. And we also, with this methodology, aim to identify gaps and propose recommendations of how to bridge them. And this methodology builds on the 6 building blocks that Carolyn already presented, and also on the E3G public bank climate tracker metrics that already assess some MDBs on their Paris alignment. Our approach is we tailor-made these dimensions on export finance and really concretized them. So we have 72 defined benchmarks that are in line with the latest IEA net zero pathway and the IPCC P1 scenario, which we think is the only reference scenario that should be valid for public finance institutions, given their special responsibility in historic terms to act on climate change. And yes, next slide, please.
1 minute left.
Okay, so these are the 5 dimensions. So we have financial, non-financial disclosure, ambition of fossil fuel exclusion restriction policies, climate impact, sustainable development, and the outreach on proactiveness of ECAs. I just want to highlight that we have a weighted approach. So we contribute a lot more in the mitigation aspect rather than transparency, climate finance, or engagement. And in the end, we have a numerical score that ECAs and their governments can receive. Next slide, please. Yeah, as I'm running a bit out of time, I will skip the example of the benchmarks. We have conducted case studies on Germany, Netherlands, and Japan so far. You can access them maybe here in the chat or find them on our website. And our recommendations basically suggest to immediately phase out support for fossil fuel value chains, set science-based GHG reduction targets, enhance the scale and quality of climate finance, engage in coalitions of the willing, and really, and very importantly, engage in international climate diplomacy with China and at the OECD level. And with that, I thank you, and I'm excited to hear now about the post-2025 climate finance target. Over to you, Peter.
Let me briefly step in and introduce Peter. So we have nearly concluded our tour d'horizon. Let's look back and ahead on climate finance targets with Peter. He is a senior researcher and policy advisor on international climate policy, and a contributing author to the IPCC's 5th assessment report and a lead author to the UNEP adaptation gap reports. He currently works at Frankfurt School UNEP Center, and previously he was also employed at the German Development Institute and worked at the Institute for Environmental Studies in Amsterdam. So, Peter, up to you.
Yes, thank you very much for those kind words, and good morning, good afternoon, good evening to everybody listening. It's great that you're there. I will present on the post-2025 climate finance goal. How much more and how much better? Next slide, please. So basically, we've brought together a big consortium of researchers. Next slide, please. Big consortium of researchers from around the world, developing and development. One slide back. Developed and developing countries, researchers only, because we understand that this is a highly political topic, but we didn't want any negotiators to influence our research kind of open way of thinking in writing this. So the motivation for writing a paper, and it's still in process. We're making a lot of progress, but it's not published yet. The motivation for writing this paper is that basically in Paris it was agreed that a new collective quantified climate finance goal from a floor of 100 billion per year shall be set prior to 2025. And it should take into account the needs and priorities of developing countries. So this builds on the current 100 billion goal, but it should build on that as a floor, so it should be higher. The second context is that all of the authors, and I'm sure if you're familiar with climate finance, you recognize many names. We also noticed or have worked on the fact that the climate finance system as we have it now, so the architecture that basically all the actors that are involved, all the rules about how you account, etc., how you spend money, how you divide it in a balanced way. This system is kind of fraught with difficulties. So those two motivations we have, those brought us together to write this paper. Next slide, please. You can't write about the future goal without actually taking into account what we have so far, and also draw some lessons of the climate finance system that we have so far. And so a couple of things need to be said here. We have very ambiguous definitions of climate finance and the 100 billion target, as you all know, and it makes it very hard to measure whether we are on track to achieving it. And multiple interpretations are actually used. There's different kinds of actors that try to identify how much climate finance there actually is, and they come to different numbers. And there's a couple of reasons for that. So one is whether or not you should count all finance, so including loans, for example, at face value. Then bilateral and multilateral funding flows have been screened by different definitions and accounting approaches on whether they actually target the climate objectives. Then there's a discussion on whether funds are new and additional. It has been promised since 1992, but this issue has not been resolved. And finally, in Copenhagen was for the first time in an international agreement on environment or climate that actually private finance was an explicit part of the amount of finance that was pledged towards developing countries. And so the method to actually measure how to account for mobilized private sector finance is still being developed, and it's still incomplete and also contested. Next slide, please. So that was the look back, and then looking forward, how do you determine a new finance target? And I think it's very important to say upfront that the size of the post-2025 climate finance target will in the end be a political compromise. And that is just like the current 100 billion is a political compromise. And that is because the understanding of the needs on which this target is also supposed to be partly built is inadequate for it to form the basis of a quantitative needs-based goal. A lot more additional information was provided by the Standing Committee on Finance report, but I would still say that the understanding is inadequate. What we do say, I mean, initially we set out to kind of determine let's say the characteristics that in the end make the number or quantify the target, but we realized that that's actually impossible at this point in time. We do think that it could be somewhere between 130 billion, which is basically just a correction for inflation of the US dollar since 2009, and hundreds of billions per year. But we also noted immediately when, as authors, when discussing this thing, is that simply increasing the finance target will be ineffective to significantly improve the climate finance system as a whole, and to be more effective with the finance that there actually is. Next slide, please. So in thinking about how to improve the climate finance system, we identified a couple of priority elements that need to be reflected. And the first one, of course, and that this is one that we didn't have in 2009 when the 100 billion pledge was made, but we do have it since the Paris Agreement. And you could also hear from the other speakers in this event that it became a very important topic, is the alignment of financial flows as a whole. So not just focusing on the 100 billion or whatever the new 2025 target will look like, of flows from global north to the global south, but aligning the complete financial system to the Paris Agreement. And this is huge. This is shifting trillions rather than moving billions, and this needs to be taken into account when setting the new system. Second issue, of course, is adaptation mitigation balance. Adaptation finance remains inadequate and is far from reaching the aim of a balanced location unless you define balance in a way that more than 70% goes to mitigation. Financial instruments, very important here, is the focus, and there might be different perspectives. There are different perspectives among countries here. Is the focus of the 100 billion or of the climate finance? Is it on transferring resources to the global south, or is it about having the maximum impact? And if it's about a very clear transferring of resources, then you should work with grants rather than with loans and guarantees. But if it's about having impact, grants are not necessarily the instruments with the highest impact. Then, of course, the role of private finance mobilization. I mentioned that already, and this also relates to the financial instruments that you use and Article 2.1c. And then finally, the new and additional finance. I've mentioned it on the slide before. This continues to be an important issue for developing countries, but we feel that the relevance is fading of new and additional finance because there's a moving target because of Article 2.1c. Next slide, please. So then also, but if you are kind of addressing the climate finance system a little bit in order to be able to set a target for post 2025, then you might as well take the opportunity to also consider further improvements of this system. And one, of course, is the new sources. So could the list of climate finance providers be updated? This list is currently from 1992. No changes have been made except for Turkey that was taken off the list. But the world has changed dramatically since 1992. And so it would make a lot of sense to also consider new provider countries to join the current provider countries. You could also think more seriously about innovative sources like a tax on international maritime or air transport. Other issues that are important to keep in the back of our minds when we're thinking of the climate system and how to improve it is the prioritization of climate finance. The Paris Agreement prioritizes LDCs and SIDS. The GCF also adds Africa for adaptation, for example. Should there be a more clear kind of prioritization towards the poorest and most vulnerable countries? And the third one, of course, here is access to finance, which is something developing countries are very worried about, that the accessibility is still not good enough. Next slide, please.
1 minute left.
Yes, so this is my last slide. So as I mentioned, we're working towards this article on what the post-2025 climate finance target could look like. We can't really, put a quantity on the table. We can't say it should be this much or that much. It is in the end a political compromise, but we do have a couple of suggestions. And the first one is, based on the lessons learned of the last 10 years. And the first one is that a well understood transfer of resources to developing countries will increase the transparency, accountability, and trust in the climate finance system. So it's important to keep this in mind. It's very important to keep the negotiations running as well. And therefore we propose a collective minimum grant sub-target. So collective, so all provider countries together, minimum grant sub-target. And this could be either absolute, and again, it's not up to us to set a quantity, but it could be an absolute one, or it could be an increase compared to the current amount. And then, of course, you need additional targets, because you need to structure the new climate finance target better than the current target is structured. So it should be accompanied by at least one additional target, and that could be a total public finance climate target. So also for other instruments such as loans and guarantees, or a total mobilized climate finance target, or a combination of the two. But it's also important to note that the more rigid you make the system, the more flexible it also becomes, of course. And then finally, and again, it's very important to emphasize this, is that the mobilization of private co-finance should become, or at least that's our expectation, should become easier as countries start to implement Article 2.1c, because it should decrease investments in brown investments, and it should increase investments in green technologies and adaptation. So yeah, that's it. Thank you very much. And back to you, Catherine.
Thank you very much, Peter. And thank you so much to all of our speakers. We just got the question in the live chat if slides would be available for the audience. And I would suggest that people reach out to you over the networking area on the website of the EU side events directly, so you can get into contact and share presentations. So let's now take some time to reflect and discuss what has been said. We have about 14 minutes left, and I will briefly introduce our guest speaker, who is today Tasmin Essop from Climate Action Network. She is the executive director of the largest global network of over 1,300 civil society organizations that are active in over 120 countries fighting the climate crisis. She has just completed serving her second term as commissioner in the National Planning Commission in South Africa, appointed by the president, and leads the work on climate change and just transition. She also headed previously the climate team at World Wildlife Fund International and served as the head of delegation for the organization at the UNFCCC. She was also in previous years an anti-apartheid activist from an early stage in different capacities until the democratic elections in 1994. And she was also serving as a member of the provincial parliament in Western Cape and served as provincial minister in several capacities. Tasmin, we are really delighted to have you here, and we're really looking forward to your reflections. And I also recommend that we then directly step into a discussion, and we will also pick the questions from the Q&A from the live chat. Thank you. Over to you.
Thank you very much, Catherine, and greetings to all from Glasgow, where the internet is not stable and there's very little private space to do this kind of thing. So forgive me if you see disturbances. Let me firstly thank all the presenters for their interventions. The interventions and the research done and some of the key findings and recommendations are really valuable, and in fact should be valuable for the process that we are engaged in right now at these COPs. And as you know, climate finance is one of the key issues on this agenda. I thought, just by way of reflections, that I want to make a couple of observations. The one that I thought, Carson, you brought up really well as a conceptual issue is the idea of shared norms. And that triggered my thinking, and you identify carbon neutrality as a shared norm. And I would like to position just a consideration of another shared norm, and to make this more broadly relevant to the kind of world we are living in right now, right? Climate finance, the provision of climate finance is not disconnected from the why and where and the context in which we're living in. And so just given this context where we've had these multiple crises, we have immense suffering, we have losses of lives and jobs, etc., just by the pandemic and compounded by the climate crisis, I would argue that potentially what we would really like to see as a shared norm globally is the concept of justice and fairness as well. So in addition to carbon neutrality, something that really would appeal, I think, to not just, we're not just talking about governments, donors and recipients, but what would appeal to citizens in the world would be a shared norm of justice. And your concept of reciprocity, which talks to cooperation and partnership again. If we look at the political realities, we've just come through a period where there hasn't been, just in terms of our experience with the pandemic, that kind of that word, reciprocity. For me, in my head, that means solidarity. That means global solidarity and cooperation. So international cooperation, the financing through that international cooperation has to talk in my language to global solidarity. And so I'd like to see that then as one in which it's not a technical relationship. It's not about, as you correctly said, it needs to be elevated to political levels, that there is an equal partnership in those relationships as well, moving away, of course, from the kind of trend of donor-recipient relationships and all of this. So I'm just positioning maybe two additional or alternative perspectives on the kind of concepts that you presented, Carson, that I think are valuable, really valuable concepts: shared norms, reciprocity, I'll call global solidarity, and the importance of involving the political levels. Because these things, there's a technical level, but then there's also the kind of political will that you spoke about. I do want to turn to the one gap that I think is there in terms of what the money is going to be spent on, and we still see the 10, that we talk about mitigation. Peter, you brought in the balance of, the need to balance adaptation, and I wonder whether I could ask, how do we deal with the IPCC Working Group 2's finding, in fact, or I would call warning, that we have entered an era of climate impacts. So, as you know, the issue of loss and damage is really an important issue to be addressed. It's not being financed at all, but we are living through an era of climate impacts. We've experienced it already, and it's going to get worse. That's the reality. So, that issue, financing for loss and damage, there's a gap in the presentations I've heard. There's no mention of the issue of loss and damage due to climate impact. It's beyond adaptation, and we are reaching the stage, as the IPCC indicates, of, pretty much entering the beyond adaptation phase. So the financing for loss and damage is not going to be through loans. Cannot happen through loans. And if we're talking about needs-based finance, certainly we're not talking about billions. We're then talking about the trillions. And so the ideas of innovative sources of finance that's being presented, we need to collectively look at where we would get these resources, and of course take a needs-based approach to this. And I would absolutely agree that the entire financial system would have to transform, quite radically, to be able to deal with the needs that we have for across the board climate action as well, including just transitions. And I'm very happy that Carson mentioned South Africa and the latest announcement of support by the EU and others. The challenge, it is very, very important for South Africa to phase out of coal faster than that they were probably going to be able to do. And now the challenge is to ensure that that support for a phase out of coal really is done in a way that ensures a just transition as well. And so all this financing of mitigation especially to move away from fossil fuels and its dependence on fossil fuels for many developing countries and developed countries would have to ensure that that would be done through just transitions, where again, you put the needs of those most impacted by these transitions at the center, workers, impacted communities, etc. I promised I wouldn't take all my time, Catherine, because I know you would want an engagement. So I'll leave it at there. These were just high-level observations and thoughts that I would like to hear back from you as well.
Yeah, I think the speakers can now also give her thoughts on what Tasmin just has been said. And then I have just 1-2 questions from the live chat I would like to ask you.
Very briefly, I think putting it to the word of solidarity, I feel indeed that is something that is missing in the conversations, how we look at it. I feel solidarity is something that I can relate to. Loss and damage already makes it very complex technocratic terminology, which again, I think is the difficulty I see, at least if I look at the domestic discussions, we will look a lot within Germany, that there's even senior policymakers. I think they are interested to find some way of contributing globally, but all the mechanisms at the moment look very abstract and complex. And so I think really bringing that down to solidarity and perhaps climate neutrality, or whatever kind of terms resonate best at the end, and then making tangible that there's opportunities that you afterwards can showcase, look, it worked and it was worthwhile the effort and the resources to go in there. I think that is something I hope the conversations now in Glasgow, but also kind of mechanisms that we can develop there and cooperations, perhaps more bilateral than in the past, can really contribute to.
Yes, maybe very brief on loss and damage. We do actually mention that concept also, or that topic also in our paper, but it's extremely contentious, as you know, and extremely difficult. There's different positions on whether it's included in adaptation or not, and so we do mention it. We do mention that it's important, but we do not propose any solutions on how to integrate or exclude it in the climate finance target from 2025 onwards.
Yeah, thanks a lot for your thoughts. I can relate to this, to the idea of climate justice, and we look so much on the ambition of fossil fuel phase-out policies because we think it's a precondition for achieving climate and intergenerational justice. And this is just why we urge especially countries like Japan, Canada, China, and South Korea to phase out their public support in for fossil fuel value chains, because they are the largest financiers of these value chains. And what is, I think, important to look at the export system is that countries like Germany or others that have in the past extracted fossil fuels now export technologies, capital goods, services that enable such transactions abroad. So I think this is really something that needs to be kept in mind, and the global trade system in general, has a transformation to do in the future. Thank you.
Now, Caroline, do you want briefly also comment on this? We only have 2 minutes left, so.
Yeah, I can make it really brief. I mean, I know that like my presentation focused a lot in particular on the MDBs and the kind of processes, and you see a lot of the terminology used there, and it is very technical, and it kind of begs the question of what these international institutions that are supposed to be operating on this very global level, what purpose they're serving, and how do you bridge those gaps? So, I very much agree with everything that Tasnim has outlined, as well as what other speakers has outlined. But then what terminology is used within the banks, and you're like, who are you speaking to, and how do you bridge these kind of needs?
Okay, thank you. I will just briefly have a question for Tasneem. So you somehow represent the voice for civil society here, I would say. So what role did civil society play so far in international climate finance, and how should this evolve?
So civil society has played really an immense role, and I've been, well, not just, at national levels, doing the work that they do with their governments, etc., and advocating for finance to be provided, especially in developed countries, but certainly at a global level in these spaces. We've been here for many years, from, way back, and we've been able to keep the pressure on for the provision of climate finance. That's one role. So the hard advocacy pressure work. But we've also come up with many proposals. And I remember in the days up to Copenhagen, for example, Peter raises the issue of innovative sources of finance. Civil society played a very important role, especially in identifying those things, Peter, that you're still looking at. The bunker fuels as an innovative source, the Robin Hood tax as an innovative source, etc. So we come with pressure, but we also have provided many, many proposals and recommendations. We play a key role, therefore, on both fronts.
Okay, thank you so much. Time is over, unfortunately. So please ask your questions in the networking area. And thank you all for attending our session. Have a nice afternoon, evening, or morning, wherever you are. Bye.